from this high down to the 41.46 even level. Now, why am I referencing that? Because that's the target I told you price was going to go to today, this morning on Twitter. It's going to return back to what? The new week opening gap. It's going to be like a magnet, folks. It's going to want to draw back to that. Why? Because for the week, for the entire weekly candle, from between the highest high and the lowest low, if it's not a trending market, what's it going to do? It's going to treat the new week opening gap as fair value. And it's going to want to revert back to that continuously. And that allows for new sentiment to come in. Oh, it goes back to that gap? Okay. A lot of algorithms, not the algorithm that's the price engine, but the algorithms that operate on the fund level, they will likely use that opening gap to constitute their new trade idea based on a new sentiment idea because it trades back to it. Much like I'm teaching you to view it as what? Support and resistance. So if it's up here, what's the nearest price above the gap? It's the Friday's closing price, which is 41.46. So if that's the level we're looking for price to go to, and we're above it, and we're looking for lower prices, we create a high here. It starts to pull back and go below the high here and the relative equal highs that we've had now 4 times. Remember the slide before I went to this one? 4 times it banged into that level, and then we hit it here and then started to sell off. Where are we at when price is trading right here? Are we in the red area, which would be considered premium relative to the high, to the target where we're looking to trade? Or looking for the draw on liquidity, the terminus. Where is it likely to go to? Remember, that's the thing I'm teaching all of you to focus on. The storyline is they ran the buy stops above those highs, broke lower. When this thing starts to break down and we have a target, 41.46, you need to take your high, the high that forms that you think is a suspect high. A suspect high is a high that's been blown out, and you want to see if it maintains the rejection. So we don't know if this high is going to be, well, taken out, if you will, until we trade from premium to discount. We have that right here. Then the market does what? Returns back up into a premium. If price is up here relative to that target and the high is here, if we go short in here, we're shorting what? At equilibrium or premium. Either one is okay, but you can't go in and start pyramiding once we get down into here, because once we start crossing into the halfway point of the discount level, you're too much in a discount to add more to it, which is the reason why you see me do one and done, and there it is. Pay no attention to the fact that the standard deviation 1 takes us down to that really nice low. So here's the level, that's equilibrium. Do you see the volume imbalance right here? That volume imbalance is at equilibrium and then a very small premium. My entry was short, instantly delivered. This type of movement right here, that is exactly what a low resistance liquidity run signature performs like. When we get in, we're looking for very quick responsiveness in price. Look closely, the volume imbalance here. Why am I even looking at that? Because of everything I just outlined, how fast we move from this high. It's not likely to do what? Come back up to any of this imbalance. It's showing us what? Volume imbalance here, fair value gap, another fair value gap, another volume imbalance that did what? We traded up into it here with that little bit of a wick, and we went down into discount, halfway between the high here and the target of 41.46. This returned back into that volume imbalance right there. That's it. That's the last bus stop. And then we're out of here. So the narrative was run the buy stops, accumulate that as a short position for smart money. So the composite man sells short to the buy stops and buys the sell side liquidity to cover the short.